I have shown people 10 times S stocks before. I have pointed to companies that looked almost invisible before they became obvious, and then watched them multiply while most people were still debating whether the story was real. Let's put as exciting. It always is. But excitement is not the same as usefulness. A stock can make you very rich on paper and still leave you waiting years before it changes how your life feels month to month. That is the part people rarely think through carefully enough. They chase growth because growth is glamorous. They chase the dream of a portfolio that will someday replace their job. But they ignore the pressure of the present. Rent does not care about your 5-year upside thesis. Groceries do not care that a stock might triple if management executes. Utility bills do not accept future potential as payment. Life keeps sending invoices while you are waiting for the great compounding story to mature. So if I wanted to build something more intelligent, something that could actually start changing my life immediately, while still preserving the possibility of becoming very wealthy, I would not rely on one growth stock alone. I would build a system that is the first rule. A portfolio becomes much more powerful when one part relieves the pressure of the present and another part compounds toward the future. That is exactly the structure I want to walk through here. 2 income producers to take the pressure off your bills. Now, 1 serious growth stock to expand the whole machine later. Then a shift system to gradually move capital from growth into income until the income engine becomes strong enough to replace your job. That is a much more mature way to think about wealth than simply yelling 10 times S stock and hoping the audience fills in the rest. Now let us start with the first income stock because this is where the emotional breathing room begins. Trinity Capital. Ticker TRIN. I like Trinity for a very specific reason. It is not trying to be heroic. It is not pretending to be some moonshot technology bet that will reinvent the world. It is a business development company, a BDC, which means its job is much simpler and much more direct. It lends money, it finances equipment, it makes investments in private companies, and in exchange for the structure and tax treatment it receives, it passes a large portion of its income back to shareholders. That is why the yield is so high. In the source material, Trinity is producing a forward yield around 12.5% and has recently paid closer to 13% over the past year. That is real income. Not theoretical yield from a distressed stock that looks generous because the market is terrified. Real cash being paid to owners because the structure is designed to hand most of the earnings through. Now, high yield alone never impresses me. Yield by itself can be a trap. That is the second rule. If a stock pays a huge dividend, the first question is never, how much can I collect? The first question is, how durable is the machine producing it? That is why I care about Trinity. S internal structure. The company is not just spraying money around into one fragile corner of the market and praying repayment arrives. In the source material, Trinity's portfolio includes about $1.8 billion in secured loans spread across 95 companies, plus roughly $336 million in equipment financing across 22 companies. That matters. Secured lending matters. Asset-backed exposure matters. Diversification matters. These are the traits that separate an income machine from a temporary illusion. And more important than the current yield, Trinity has grown the dividend power meaningfully over time. In the source discussion, the dividend growth rate over 5 years comes in around 51%. That tells me the payout story is not simply a static coupon. It is a distribution engine that has shown the ability to improve. Now, I also understand the concern, private credit, venture debt, software lending, all the things people worry about when sentiment turns and everyone starts wondering whether smaller growth companies will be able to refinance, survive, or keep paying. Fine, those are real concerns. But the source material also points out why Trinity stands apart from some of the weaker names in the space. Its loans are spread out. It is not overwhelmingly concentrated in the most feared corner. The software as a service exposure, the part that people are especially nervous about because of AI disruption and private credit fears, is only around 10% of the portfolio that matters, because the market does not usually punish a category gently. It tends to punish first and ask questions later. When a BDC keeps proving that its portfolio is broader, more secured, and less concentrated than the fear suggests, it can recover faster than the crowd expects. You can see that in the stock behavior described in the source. Trinity sold off during bouts of private credit anxiety, then rebounded sharply. That tells me the fundamentals are doing enough work beneath the surface that each fear cycle has become more of an opportunity than a collapse. Now, does Trinity have huge upside as a stock price? Not necessarily. That is not really the point. The point is that this is a monthly payer with enough yield to matter immediately. That changes the emotional experience of building wealth. If you own a portfolio that throws off cash every month, even if the share price itself only crawls forward over time, the machine is doing something useful right away. And that usefulness is not minor. It reduces stress. It gives you optionality. It reminds you that assets can work on your behalf instead of making you wait in silence for years before anything feels real. That matters. Now let us go to the second income engine, because this is where the structure becomes much more interesting. Most people expect the second income stock to be another classic high-yield payer. It is not. It is Ether, the iShares Ethereum Trust. And by itself, Ether does not pay a dividend. So why put it inside an income system? Because sometimes the best income vehicle is not one that pays you directly. Sometimes it is one that gives you enough option premium that you create the income yourself. This is where most people stop thinking, because they hear options and imagine recklessness. Fine. There are reckless ways to use options. There are also disciplined ways, and in this case, the structure is very clear. You buy the ETF, you own the exposure, then you sell covered calls against those shares. That creates monthly income, not imaginary income. Actual cash in the account from selling someone else the right to buy the shares from you at a higher price. Now why Ether? Because the bigger story under Ether is not just crypto enthusiasm. It is tokenization. This is what the source material gets exactly right. We are moving toward a world where ownership of assets, from stocks to real estate to money markets to bonds, gets packaged in digital form and moved through tokenized systems that are faster, cheaper, more fractional, and more continuous than the infrastructure people are used to. Robinhood is already pushing into tokenized assets. JP Morgan is building there. Walmart and Amazon are exploring stablecoin structures. Goldman Sachs is thinking through tokenized money, market frameworks. That is not noise. That is the early shape of a new system. And Ethereum sits close to the center of that infrastructure, not as a slogan. As plumbing, that is the third rule. The most valuable part of a financial revolution is often not the app people see. It is the infrastructure quietly handling the flow underneath it. That is why Ether is so compelling here in the source material. It is up strongly over the last year, yet still well below prior highs. That combination matters. You have proven volatility, proven upside, and a structure volatile enough that monthly options premiums are worth collecting. That is exactly what a disciplined covered call seller wants. An asset with real upside potential, but enough implied movement that you get paid generously for giving up some of that upside in a short time frame. Here is the simple version of the system. Suppose Ether is trading around $17.62. You buy 1,000 shares, about $17,620 worth. Then you sell 10 covered call contracts, because each contract corresponds to 100 shares. Pick a strike price high enough that you still have decent upside room, say $19 in the source example. Now, if Ether rises to that strike, fine, you sell the shares at a profit, you collect the gain from $17.62 up to $19, and you also keep the premium you collected up front for selling the calls. If Ether does not rise that far, you keep the shares and you keep the premium. Either way, the structure is producing cash. In the source math, that premium comes in around $740 for the month on a $17,620 position, or roughly a 4.2% monthly cash yield, before repeating the process again next month. That is enormous compared with the sleepy payout behavior people are used to from conventional dividend stocks. Now, I want to be honest, this is not magic. Covered calls are not free money. They are a trade. You collect current income in exchange for capping some upside beyond the strike. So this approach works best on assets you like owning and are comfortable selling at the chosen price. That is why I think Ether fits so well. It is volatile enough to pay you beautifully, but it also sits on top of a thematic story. Tokenization and Ethereum infrastructure that has real long-term tailwinds behind it. That combination is rare. And if you can collect high monthly cash while waiting for that theme to unfold, you improve the whole emotional profile of the portfolio. Now pause and notice what we have built so far. Trinity provides very high traditional dividend income. Ether provides synthetic monthly income through covered calls. One is a structured lender distributing most of its earnings. The other is an infrastructure. Theme trust made productive through option premium. They are different engines. That is exactly why I like them together. The fourth rule, the strongest income systems usually combine different cash flow mechanics rather than relying on one single kind of yield. Now comes the growth engine. the stock that is supposed to make the whole machine far bigger than it is today. Credo Technology Group, ticker CRDO. This is the part most people get seduced by too early, because growth is always the piece that sounds sexy. Fine, let us respect it without becoming stupid. Credo is not just another AI stock people throw into a thumbnail. It sits inside one of the real choke points of the AI build-out, networking and connectivity inside the data center. That matters because AI does not just need chips. It needs the infrastructure that moves the data between the chips, the servers, the storage, and the systems that keep the whole machine alive. That is the part many investors miss. Everyone loves the glamorous silicon at the top of the story. Far fewer people ask what actually lets the system talk to itself. Credo's chips, cables, optical products, and related connectivity gear sit right inside that bottleneck. In the source framing, the company is essentially part of the plumbing of the AI data center. And I love plumbing businesses when the world is distracted by the shiny fixtures, because the plumbing is what everything else depends on. Now, the first thing I always ask with a growth stock is not whether the story sounds big. Of course, the story sounds big. The first question is whether the company is actually taking market share. And market share shows up in sales growth. Here, Credo looks extraordinary in the source material. Trailing 12-month revenue growth is around 226%. Forward analyst estimates still point to about 120% growth. Those are remarkable numbers, not incremental, not merely respectable, remarkable. Now compare that to peers in adjacent infrastructure and connectivity categories, names like Astra Labs, Arista Networks, and Broadcom. Those are good businesses. I like some of them very much. But in the source comparison, Credo is growing much faster than the larger incumbents and even outpacing Astra on some measures. That tells me this is not just a company riding the AI wave. It is a company winning inside the wave. That is a completely different thing. And if you want outsized returns, that is what you need. The fifth rule, the best growth stocks are not merely exposed to a trend. They are taking share inside the trend faster than the market fully expected. Now, let us talk size, because size determines upside almost as much as quality does. Broadcom is an outstanding business, but in the source material, it is already near a $1.9 trillion market cap. Wonderful company. But when a business is already that enormous, you do not usually get another easy 10 times FROM there. The base is too large, the math becomes brutal. Credo, on the other hand, is far smaller. Roughly $32 billion in the source discussion. That matters tremendously. A company at $32 billion can become $320 billion and still be a meaningful but not absurd piece of the technology landscape. That is the asymmetry. The business can be good enough and still small enough that the room for a real re-rating remains large. Now, growth without profitability is dangerous. So the next question becomes, can Credo turn those sales into real earnings power? The answer, according to the source comparison, is yes. Gross margins around 67%. EBITDA margins around 32%. That is not a charity case. That is a company translating growth into operational quality. Yes, some peers like Broadcom and Arista have stronger scale and, in places, better margin structure, fine. But they are also far larger and therefore carry less multiple expansion potential from here. Credo's combination of size, growth, and improving profitability is what makes it special. It is not the cheapest stock on standard measures. Price to earnings and price to sales are not low in isolation, but they rarely are when the growth rate is this strong. That is why I always tell people not to ask only, what is the multiple? Ask, what am I getting for the multiple? If sales are growing 120% or 200% and margins are already real, the valuation starts looking very different. Now let us build the system, because having 3 good ideas does not matter if you do not know how to arrange them. In the source material, the example starts with a $50,000 portfolio, roughly the kind of size many ordinary investors actually have. That matters to me. I do not enjoy portfolio designs that only work if somebody already has a few $1,000,000 sitting around politely waiting for instructions. Here is the simple structure. $10,000 in Trinity, $20,000 in Etha with the covered call income system. $20,000 in Credo as the growth engine. Now think about what that does. Trinity throws off meaningful monthly income right away. Etha throws off even larger synthetic monthly income through the covered calls together. The source math gets you to just over $1,000 per month in immediate cash flow. That is not full financial freedom for most people. It does not have to be. It is enough to reduce pressure, enough to cover part of the rent, the car payment, utilities, groceries, insurance, or whatever part of life feels heaviest right now. That is why I like this. It changes how the portfolio feels early. Then Credo does its job in the background. The source model assumes something like a 25% annual return. That may prove too high or too low in the real world. Fine, the exact number is less important than the mechanism. The growth sleeve expands faster than the income sleeves, and every few years you rebalance part of those gains into the income names. That does two beautiful things. First, it increases the cash flow over time. Second, it harvests some of the growth gains and turns them into more stable income, producing assets before the growth stock has the chance to disappoint you later. That is mature investing. The sixth rule, the smartest portfolios do not just chase growth. They periodically convert some of that growth into dependable cash flow. In the source example, the system gets rebalanced every 3 years. That means some of the gains from Credo move into Trinity and Etha, and the monthly income starts climbing from just over $1,000 a month initially to around $1,700 by year 6. Then roughly $2,400 by year 9, and by year 12, after a full rebalance into the income sleeves, the monthly income runs above $5,000. That is where the job replacement idea becomes real. Not because one stock became a miracle, because the whole system matured. That is what people keep missing. They want the miracle stock and ignore the transfer mechanism that turns market gains into a life they can actually live. Now, could you push the timeline faster? Of course. If you wanted no immediate income and put everything into the growth stock, then in the right scenario, the portfolio could become larger faster. But that misses the entire psychological advantage of the system. The immediate income is not a rounding error. It is emotional oxygen. It lets you stay patient. It lowers the pressure to interrupt the plan. It keeps you from staring at the growth stock every week, demanding that it justify your rent. That is a huge advantage, because portfolios fail less often from bad ideas than from emotional impatience. Now, could you put everything into the high-income Etha covered call structure? You could, and people often ask exactly that question. If one part yields 4% or more per month, why not just live there? Because concentration risk is real. Because no single idea should dominate the whole machine. Because the lower yield sleeve in Trinity brings different economics, different risk, different diversification, and because a real growth stock like Credo is what ultimately lets the system escape the trap of just milking yield without expanding the underlying asset base enough. You need all three roles: immediate income, tactical income, long-term growth. That is the beauty of the structure. Now let me tie it all together. Most people search for one stock that will save them. That is child's thinking. One stock can change your life, yes, but usually only after time, volatility, doubt, and a great deal of patience. In the meantime, life keeps billing you. So the more intelligent approach is to build a system where part of the portfolio begins helping right away, and the rest of the portfolio compounds with enough runway to become something far larger later. That is what Trinity, Etha, and Credo are doing here. One gives you high monthly distributions. One lets you manufacture high monthly cash flow through covered calls on top of a massive tokenization theme. One gives you a real shot at equity upside through AI infrastructure growth. Then the rebalance system slowly shifts the center of gravity from aspiration toward cash flow. That is how you turn the future into something you can live on. That is the seventh rule. The strongest wealth plan is usually not the one with the flashiest stock. It is the one that gives you enough cash flow to stay patient while the growth compounds. If I were starting with $50,000 and wanted to build something that could one day make more than my job, I would not just buy a growth name and pray. I would build the machine Trinity for monthly yield, Etha for premium income and tokenization upside, Credo for growth. Then I would let time, rebalancing, and discipline do what panic never can. That is how I would do it. And if I were serious, I would start before another year slipped by while I was still admiring the idea instead of owning the system.